Hi everyone, I'm Jeremy Zirin, Senior Research Analyst for Real Assets, and the title of my flash talk today is Exploring Opportunities in Non-Core Real Estate. But non-core real estate can mean a lot of different things. To some, it might mean value added. To others, it may mean opportunistic or even development. But you know what? I'm actually not going to be talking about any of these things today, and instead, I'm going to be talking to you about non-traditional property sectors, such as senior housing, student housing, life sciences, medical office, self-storage, and why these sectors are important, particularly in today's market environment. Before I begin, my agenda will include a discussion on the key attributes of non-traditional property sectors, followed by a handful of case studies, key performance benefits, how to invest, and finally some key takeaways. Before jumping in, I want to first frame the conversation with a comparison of what traditional property sectors are versus non-traditional. So traditional property sectors such as retail, office, industrial, and multifamily are what you should all be most familiar with because these sectors represent the majority of the real estate investment universe and are most likely in your real estate portfolios today. While each of these property sectors are unique relative to one another, the well-being of most of them is tied to the economy. For example, the office sector tends to underperform during times of recession due to companies deciding to downsize. Non-traditional property sectors, such as senior housing, life sciences, student housing, and self-storage, on the other hand, require specialized knowledge and resources and have a wide range of demand drivers that can be both cyclical and secular. Some of their unique features include fragmented ownership, where the bulk of the properties are still owned by specialized operators, mom and pops, and even health systems. They also have defensive characteristics, such as stable operating fundamentals that are less correlated with the economy, and needs-based demand, which can create sticky tenants and high retention rates. And lastly, demographics, which can provide a picture to the future, which I'll have more on later. So let's dive right into some attributes. The senior housing, medical office, student housing, and self-storage sectors are believed to have $1.3 trillion in real estate value. To put this in context, $1.3 trillion only represents about 12% of the total real estate investment universe, but the market size for non-traditional property sectors is growing. Investors in these non-traditional sectors include institutions, both US and foreign, and both private and public capital in the form of specialty REITs. Non-traditional property sectors have many unique features, but one of the key attributes is that they're less sensitive to GDP compared to traditional sectors. This chart shows the sensitivity of value to a 1% change in GDP. And you'll note that manufactured housing, student housing, medical office, self-storage, active adult, single-family rentals, and even senior housing, all the non-traditional property sectors are among the lowest. So if you believe that we're nearing a market correction, then this is a key feature that may help provide protection in a down market. All right, let's have a little fun now. Would you believe me if I told you this was my living room? Yes. Well, now that I just got married in July, there's no way my wife would let that happen. I'm just kidding. Seriously, this is not my room, in case you're wondering. But we did have a lot of stuff together and not enough room to put it, so we decided to get self-storage. Self-storage, can you believe there's an entire industry based on keeping an eye on your stuff? Self-storage doesn't just provide space for the hoarder community. In fact, usage is driven by life events such as moving, going away to college, divorce, and even military deployment. It's also good for businesses when they need space for inventory or records, or when the seasons change and you just need a place to store your boat. Many of these events are non-cyclical and can take place any time of the year regardless of the state of the economy. Self-storage has historically exhibited low correlation to GDP, has high net operating margins, and low capital improvement costs compared to traditional property sectors. For instance, capital expenditures as a percentage of net operating income for self-storage is only around 5%. This compares favorably to retail and office, which can be as high as 19% and even 28% respectively. Would you believe me if I told you I lived here? This is actually true, I did live here. This was my freshman dorm at college. It's Douglas Hall at Northern Illinois University. And while it wasn't under construction when I was living there, it was still pretty much a dump. There were small rooms, nothing attractive about it. It was pretty bad. But this is what new student housing looks like. Modern amenities with purpose-built communities and entertainment in order to attract students today. Student housing is a unique property sector because demand is driven primarily by demographic and enrollment trends, which result in a defensive and resilient investment strategy, particularly during times of recession. This chart illustrates this point by highlighting the inverse relationship between job growth and college enrollment during times of recession. Also unique to student housing is that leases renew every 12 months and are often backed by parent guarantees for rent payments and, of course, the damages. All right, so who in the audience knows what sport this is? Just say it out loud. Pickleball. Oh, good, I heard it. So pickleball, if you didn't already know this, is the new shuffleboard and popular sport among the active adult community. Active adult communities, for those of you who are not familiar with the term, refers to age-restricted communities, typically 55 years old and older, that have amenities, activities, a la carte services, and even social groups that are typically located near destination-type retail and entertainment. In fact, I have an aunt who lives in a senior community down in Delray Beach, Florida, and it was once a thriving active adult community, but today doesn't look anything like this picture at all, and instead reminds me of a Seinfeld episode where Jerry's parents live in Del Boca Vista. Can you picture it? Well, even though her community hasn't changed since she moved down there 30 plus years ago, it's actually in a great location because she doesn't drive, and it's actually really close to a casino, and she goes there every single day, and also she just walks there. That's her entertainment. It's perfect. The aging baby boomer generation is expected to generate significant demand for seniors housing over the next several decades. 40 million Americans are currently 65 plus years old and older, and this group is expected to increase to 72 million by the year 2031. 12.7 million Americans, as shown in this chart, are currently 80 years old, and this group is expected to increase by 3.9% by 2031. There's a wide spectrum across the senior housing communities, ranging from age-restricted active adult, which doesn't require any skill or care, to skilled nursing, which requires 24-hour care. To run a successful senior housing program, it's critical to partner with experienced operators. This is not the case for traditional property sectors, which don't require the same level of servicing. And from an investment standpoint, there's a huge need to replace outdated facilities just like the one my aunt lives in, and also within the independent living, assisted living, and nursing home care communities in which demographics are driving this demand. All right, does anyone in the audience know what city this is? No one? I heard Boston, I heard Seattle. This is Cambridge, Massachusetts. And if you're wondering what's so special about it, let me show you. Cambridge is one of the top life science clusters in the world, and it's situated right next to MIT, which is highlighted in that red zone on the right-hand side. Life science companies include large global pharmaceutical companies known as Big Pharma, medical device companies, research universities, healthcare institutions, and even startups. While many of these life science companies are situated throughout the US, many of them have now clustered together in cities such as Cambridge, San Francisco, San Diego, New York and New Jersey, North Carolina, and even Seattle. The life science sector is the most research-intensive industry in the United States, and it has about $100 billion in annual funding. Powerful demographic drivers are boosting demand for life sciences and healthcare generally, given the aging population and drive to cure diseases. Decades of research and development led to new drugs and medical treatments ready for commercialization. Compared to traditional office sectors or office buildings, life sciences and lab offices are difficult to operate and require close property management and tenant relationships. The buildings themselves contain a combination of uses, such as lab space, research space, and even specialized computing space, and all of which is very expensive to build out. Tenant improvements can exceed $250 per square foot. Compare that to traditional office, which is only about $20 per square foot. From an investment standpoint, however, the life science sector is a high-growth sector within real estate with above-market NOI growth that outpaces traditional buildings, as shown on the table on the right. So I've highlighted some of the benefits and demand drivers of non-traditional property sectors, so let's take a look at historical performance. Peak to trough, education, healthcare, and storage sectors achieved higher total returns than traditional sectors during the last recession, starting from year-end 2006 to mid-2009. Student housing was impacted less by the global financial crisis compared to traditional apartments. Net operating income continued to grow during 2009 and 2010, and demand increased since more students went back to school during the recession. And while self-storage experienced limited NOI growth during this period, NOI rebounded faster than most traditional sectors as a result of short-term leases, which helped take advantage of the rising markets compared to traditional sectors that had longer-term leases. So how do you invest? There are many ways to invest in non-traditional sectors. Private funds are available, either sector-specific or diversified, with both closed-ended and open-ended options, and with different risk profiles, but the options are much more limited compared to the public market due to how operationally intensive these sectors are. It's critical to have relationships with the right operating partners, which most traditional real estate managers just don't have. As of the end of 2018, there were 85 non-traditional publicly traded REITs across 12 different sectors, and with a market cap of $550 billion in the FTSE Nareit All Equity REIT Index. On the public side, it's common to see REITs that either specialize in one particular sector or are diversified in several of them. For example, healthcare REITs may invest in senior housing, medical office, and in some cases, life sciences. So to conclude, the non-traditional property sectors require specialized knowledge and resources and have a wide range of demand drivers that can be both cyclical and secular. As a result, these sectors exhibit defensive characteristics, which can help protect in a down market and may act as a complement within your traditional core real estate portfolios. With that, I'd now like to welcome up Nicole Johnson-Barnes, who will be discussing global risks in the market. Thank you.